Using pending orders can help you limit risk, maximize your profits, and semi-automate your day trading efforts because you pre-enter your price levels. And traders can use stop loss orders to limit potential losses, take profit orders to lock in profits. And by using these pending orders, you can also avoid emotional trading decisions. You can stay disciplined in your approach. They're just orders that are set in your platform to buy or sell a security at a specific price level. It's different from the current market price. So these orders are going to remain active and they're going to remain open until they're executed or they're canceled. Some brokers will offer you a time limit. And there are several types of pending orders: limit orders, stop loss orders, take profit orders. Limit orders, just an instruction to execute a trade only at the specified price level or better. Stop loss orders, minimize your losses by automatically selling your asset, your security, or whatever, once it reaches a price you set to protect your position. Take profit order, well, it takes profits when price reaches your set levels. So compared with market orders that involve buying and selling immediately at the best available price in the market, with pending orders, you get a little bit more control over the execution price of your trade. It's not foolproof. Nothing is. There is slippage, there is rejection, but there are some huge benefits to using them. So let's say there's a stock, it's trading at $50 a share, but you believe it's going to drop down to $45 a share and then it's going to bounce. Well, you could place a buy limit order at $45. So this way, if that stock does drop down to your price of $45, your order will automatically be executed and you'll have entered into this trade at the price that your strategy had called for. Now, there's four main types of pending orders in day trading. There's other orders. These are four main ones. Buy stop order. Enter a long position when the market breaks through a specific price level. It's placed above current market price. When the market reaches that price, the order gets executed as a market order. Sell stop. You want to enter a short position when the market falls to a specific price level. Again, it's placed below the current market price. Buy limit. This is used to enter a long position when the market retraces to a specific price level. So a buy limit is placed below the current market price. When the market retraces to that level, the order gets executed. Sell limit, just the opposite. Market rallies to a specific price level, your sell trade gets entered, and in a perfect world, the trade goes in your favor to the downside. Now, there's two types of trades are the basic entries for any traders: the market order, the pending order. So market orders will allow you to buy or sell immediately at whatever price is available. And it's great for those who want quick executions, but it may not be suitable for those that are looking to limit risk, as slippage can occur on these. Opposite side of that, pending orders is going to give you more control. We talked about that because there's specific conditions that have to be met before they're executed. Let's say I think stock XYZ is going to increase in value once it reaches $100, so a breakout. You place a buy order with a limit price of $100. So if the stock hits the price point, you're automatically in that trade. So how do you use them in day trading? Stop loss. You set up as a pending order to automatically close your position if the trade goes against you. Your take profit, set as a pending order to exit the trade when it reaches your profit target. And a limit order, just use it as a pending order to enter into a trade at a specific price point. Let's say we're going to be day trading. We're going to use pending orders. How do we do that? First thing we have to do is determine our desired entry point based on technical analysis, market trends, whatever you're using. Second, we got to set a buy stop order above the current market price if you're looking to go long, or a sell stop order below the current market price if you want to go short. Now, these are for breakouts. So once your pending order is set, this is number 3, monitor the market for any changes that may affect your trade before you get into the trade. Number 4, if your order is triggered, make sure you have an exit plan in place. We do not want to miss out on potential gains or let our losses spiral out of control. Now, there's positive and there's negatives to using pending orders. In a pro, you get better price control. There's less emotional decision making. It automates your trade execution and it makes you stay disciplined. The cons, well, your orders may not be executed if the price isn't met, depending on what order you're using. It requires continuous monitoring of the market prior to entry. You want to make sure you're not getting into a trade when conditions have changed. Partial fills can occur with limit orders depending on what you're trading and how much liquidity is there. And stop orders may trigger during short-term spikes in price. You got to be careful with those as well. The power of pending orders, it can't be underestimated, right? By using these tools, you get to limit your risk, you get to maximize profits. And that may not be possible if you're just sticking with market orders for all your trading. Again, pending orders are going to come with some risks. You got to adjust your strategy when market conditions change. It's that simple. Now, patience. Don't forget this one. Sometimes waiting for that perfect execution can actually mean the difference between a profitable trade and a pretty costly mistake. It's up to you. And I believe that with careful planning and execution and, of course, discipline, your trading game can absolutely improve. Make sure you hit like, subscribe to this channel. We'll talk to you soon.